So actually, if you see, last year fixed income funds outperformed the equity fund, and although on a full year basis, equity funds still had a positive year. The index was up about 5% odd. Most of the actively managed funds actually outperformed the index. So the returns were not insignificant, but actually fixed income outperformed equity. But as an investor, you have to have a balanced portfolio across asset classes. You cannot just gravitate towards one asset class. The other piece is, I think you have to be invested in the market. You have to refrain from trying to time the market, because it's impossible to do on a consistent basis. And actually there has been a study that it was actually on global markets, that if you kind of miss out on some of the big trading, you actually lose nearly 40% of the return. So it's really impossible to kind of time those. Lots of time those big moves happen even without a fundamental announcement. It's just that the market is oversold. There's a big short covering. So you have to stay invested for the longer period of time. And I think my personal belief is it's really not about large cap, mid cap, small cap, etc. I think risk is best controlled by being invested in a longer time frame. And there is statistical evidence for this as well, that both your expected return and the standard deviation of return improves the longer you are in the market. So if you are invested in the market for 3 years versus 5 years, and you do on a rolling return basis, I think on a 5 year or a 7 year basis in India, there is no period of actually negative return. So the probability that you will have higher expected return is more if your time frame is longer. So I think it's really important to stay invested for the longer duration. It increases both your return as well as reduces the risk.